Hi everyone, it's John Cresswell with Duff Phelps, and we're here today talking clean energy with portfolio managers Ben Belowski and Eric Fogarty. Welcome guys, thanks for spending some time with us.
Good to see you.
Yeah. Ben, let's start with you on clean energy. It's a hot topic right now. A lot of people are talking about it, especially with the new administration and the new year rolling around. Tell me what it is. Is it, some people will say it's a fad, some people say it's a long-term secular theme, or something in between. How do you think about clean energy, and how should we think about it?
Right, thanks John. Well, we see the shift to clean energy as more evolutionary than anything. And we see this as a transition that will take many, many years to undertake. So, Duff Phelps was founded in 1932. And since then, we've seen energy and utilities evolve in the way that energy is generated, produced, the technologies and the manufacturers involved, and even an evolution in the way that energy makes its way to the ultimate consumer. And so we see clean energy as just the latest iteration.
So in some ways, nothing new, just the latest evolution of a cycle that's been in place for many decades.
Absolutely. We see clean energy at the start of a long-term capital replacement cycle, with this transition taking multiple decades.
That's actually a great segue, Eric. You've talked about those. What are some of those long-term drivers to clean energy?
Yeah, we think it comes down to three primary drivers. First is government support. So you look at the EU Green Deal. Most recently here in the US just rejoined the Paris Climate Agreement. Over in Asia, you have countries like South Korea and Japan that have pledged carbon neutrality by 2050. And then late last year, China announced their aspiration to achieve carbon neutrality by 2060. So you have governments of the largest countries representing the largest economies essentially going all in their support on clean energy. So government support's one. Another big driver is customer demand. So currently only 5% of the Fortune 1000 sources their own power to run their own operations from renewable sources. We think there's a really long runway of growth ahead of us for customer demand. And then finally, cost. So the cost curve of renewable technology has really improved over the last several years, to the point now where a new utility scale wind farm or solar farm is on par with, if not cheaper than, traditional forms of fossil generation. So as we look at it, we really have this trifecta of dynamics between government support, customer demand, and the cost curve that's driving this shift to clean energy.
Yeah, great. Ben, we launched our strategy in the fall of 2020. What makes Duff Phelps kind of uniquely qualified for clean energy today?
Well, we saw this shift to clean energy at least 10 years ago and feel as though we were far ahead of our peers in preparing for it. In fact, we've already used that to our advantage for our global listed infrastructure portfolio. Through our legacy strengths in energy, utilities, regulatory, and legislative research, we feel as though we are uniquely positioned to take advantage of this multi-decade growth in clean energy. I would summarize it by saying that, in other words, clean energy is just a natural extension of the inherent strengths and legacy research at Duff Phelps.
Oh, that's great. Thank you. And Eric, if you think about that extension of our legacy, and you think about it being as a standalone strategy, what's our edge? How do we think about what we add and what our edge is relative to our peers in the market?
Yeah, I think ultimately our edge comes down to the fact that we have a really unique vantage point of the clean energy value chain. So as Ben said, Duff Phelps has been looking at utility companies for decades. And over the last several years, we've been seeing companies building new renewable projects. And over time, we've been seeing these commercially viable technologies get deployed into the market. So as we were starting to do research on these projects, in terms of project economics or total addressable market, we started learning a lot more about the upstream technology suppliers. So I think our edge comes down to the fact that we're really at the intersection of the companies that are selling clean energy to the end user and the upstream technology and industrial providers.
So more proven technologies, more reliability, more commercialization, not necessarily buying something that might come to fruition 20 years from now.
Absolutely. This technology is up and running and keeping the lights on in markets as we speak.
Oh, that's great. Yeah, thank you. Ben, you and I have talked a lot about what qualifies as clean energy, and you and Eric have actually come up with some eligibility requirements. Tell me what those are and tell me why it's important to have those.
Sure. Well, first, as we take a step back and look at the marketplace and look at the index, we found that the index approach was somewhat broad, not very well prescriptive, and the conditions for inclusion into the index focused on a very static point in time. We developed a more robust eligibility requirements, and we believe that is vital so that investors aren't trapped in something that isn't really green or is really just a large conglomerate that has little exposure to that long-term capital replacement cycle that we talked about. We are really excited about our approach. It involves more rigor. We require that at least 30% of revenues or at least 30% of CapEx have to meet our defined clean energy categories. We also have CO2 hurdle rates, and we look for innovators in clean energy where the technologies can be deployed in scale. We take it a step further. We look at clean energy that is going to or that is currently displacing traditional energy, fossil fuels, items involved in that long-dated capital replacement cycle that we just talked about. We believe our approach is more rigorous, more comprehensive, and more forward-looking while also balancing the risks.
That's great. Yeah, that's helpful for our listeners. Eric, as you think about once something's qualified, then we're still doing our fundamental work on it. What are some of those factors that you and the analysts are looking at from a fundamental standpoint?
Yeah, so I think a key pillar to our fundamental process at Duff & Phelps first is in our regulatory research edge. You know, Duff & Phelps has been investing in utilities again for decades. And if you look across the United States, no two states in the country are regulated the same. And we have that insight into, you know, what it takes to get a wind farm built in a state in the Midwest versus one on the East Coast. So I think regulatory research is one. Another big core fundamental piece to our research process is assessing balance sheet strength. So this shift to clean energy is going to take multiple decades and require multi-trillion dollars of investment. And our view is that in order for companies to, participate in this trend over the long term, they need really strong balance sheets. So we started, from the beginning to make sure that our companies not only have attractive growth in proven technologies, but also have the balance sheets to last for the long haul.
Great. Well, thank you, Ben and Eric, for the discussion today. That was fantastic.